Welcome to this read along, lecture, educational, whatever you want to call it, on my article Capitalism in Terminal Decline, the Compelling Empirical Data Trends. I'm Ted Rees, also known on Twitter, Medium, Patreon, etc. as at Grossmanite. This was published in August 2023, but I've been publishing for those who know my work. I've been publishing this sort of thing since around 2018, but this is the most comprehensive and cohesive version that I've produced. And yeah, we're just going to run through all of the empirical data that I've researched and put together. I think it hangs together very cohesively and compellingly in showing that capitalism is in terminal decline. I won't leave you on that cliffhanger though. I think the data also very clearly shows that socialism is what follows capitalism. It is being birthed by capitalism itself. Capitalism is heading towards total monopolization and therefore a final merger, which would therefore have to be publicly owned because there would be no exchange of ownership in a total monopoly. That is the vital point to grasp, but we will come to that later on in more detail. This is obviously going to be a dry run through of the numbers. There is a shorter version linked to on my Medium page, which focuses on the most compelling and important data trends. And there's a TikTok video that's on YouTube as well that summarizes that shorter version, again focusing on the most compelling data. And I'll obviously try to make more videos that make this information as accessible and understandable as possible. So just to illustrate this as strikingly as possible off the bat, I've shown that as capital accumulates higher and higher, that the rate of profit inversely tends to fall. World GDP has risen in absolute terms exponentially really since the 1960s, 70s, because total productive output has tended to double every 25 years. That's accelerated in particular because of the computing and automation revolutions. So I will touch more on the rate of profit, but this is just a chart from a study from Esteban Maeta, who estimates that the world rate of profit, based on a study of only 8 countries, but 8 major capitalist nations nonetheless, and obviously on incomplete data and all the rest of it, but there are several studies that show the same trend, even if the numbers differ somewhat. His study shows that the world rate of profit was around 40% around 1870 and has since fallen by the time of his study, which was published in 2014, to something like 11-12%. The trend line varies depending on all sorts of factors in innovation and production and political policy making and all the rest of it. But overall, the trend line is towards zero, not just in cycles of decades that then sort of reboot or whatever, but historically towards zero. So just a brief theoretical overview to try and explain why this is happening in fairly simple terms. The evolution of production from labour-operated mechanisation to supervised automation is abolishing the source of profit or exchange value, that is the capitalist veiled theft / exploitation of commodity producing labour's labour time. So the one thing that makes all commodities, regardless of their use value, their utility, the thing that makes them usable, is abstract labour time. They all contain labour time that makes them exchangeable. The labourer goes to work, that time that they spend operating machinery passes into the machinery, passes into the commodities produced, and then that time is realised as value at the point of exchange when commodities are sold. This historical process is not reversible. Innovation is inherent to the non-stop nature of evolution and humanity striving for labour-saving, life-enhancing progress, but capital accumulation itself demands innovation, absolutely rising productivity, and cheaper to produce commodities in order to offset falling profitability initiated by previous expansions in production. That is, as commodities are made in less time or with less labour as a proportion of the production process relative to the machinery that is used, as we innovate and as we expand the use of machinery, the labour time contained in the average commodity approaches zero, which is a historical limit to devaluation, eventually making money, capital, and commodification obsolete. The rate of profit tends to fall because of this devaluation, whereby there's less profit contained in the average commodity. So, to offset that, production has expanded, thereby expanding the overall amount or mass of absolute profit. But this just restarts the cycle, and even less profit is contained in the average commodity with each round of expanded production. Or at least that tends to be the case, and of course, the initial reduction in the outlay of labour as well as the devaluation of labour re-widens profit margins temporarily. So, socialism, which will replace private enterprise, which produces commodified utilities, with social enterprise, which produces decommodified utilities, is therefore becoming an economic necessity for the first time. And that's a vital thing to grasp, because obviously people will say, oh, we've tried socialism in the Soviet Union, but it didn't work, it failed, it collapsed, and that's a subject for another time. But the long and the short of it is that the socialist states of the past really emerged prematurely in historical and technological terms. So this chart here from McKinsey and Co. of robot prices versus labour costs, getting to the point about automation. As labour costs have tended to rise, robot prices have fallen. So this is an index of average robot prices and labour compensation in manufacturing in the US. So labour costs tending to rise obviously incentivizes the capitalists to invest more in robotic and automated production. That itself contributes to pushing up the price of manufacturing labour, because the incentive to work in manufacturing falls, and so the supply of manufacturing labour falls. That pushes up the price of manufacturing labour, for one thing, but also as production has become increasingly technical, labour has become more qualified, and that has pushed up the price of labour as well. So both of these things affect each other, and that pushes up the price of labour. And of course, as robots are produced in greater abundance in less time and in higher quality, the price tends to fall. And of course, another reason that robots are cheaper than workers is that they don't need sick pay, they don't need holiday pay, they don't even take breaks, they can work round the clock, they don't even need the lights to be turned on, so capitalists can save money on their factory bills and the like, which helps to re-widen profit margins. And this quote here is obviously quite important. Find a factory anywhere in the world built in the past 5 years. Not many people work there. That's a quote from James Manuka of McKinsey Global from 2017, which of course perhaps shows that we're closer to having a fully automated system of production in terms of commodity production than we might think. So with the decline of manufacturing employment, of course, we've seen an inverse rise in services employment, and that's important because although workers in services can create value that passes into commodities, they do tend to handle finished or near finished commodities. This graph from the United Nations and the World Bank shows that the manufacturing value added as a percentage of GDP is declining in all the major economies. You can see the UK falling from a third to last in 1980 to last place among those countries, which really makes sense because it's the oldest capitalist country and has the largest overaccumulation of capital in relative terms, which simply means that it has the largest amount of surplus capital that is unprofitable to reinvest in production. Just as the number of slaves in the US declined as a percentage of the population from approximately 25% in 1790 to 16% in 1860, before slavery ended, manufacturing workers declined as a percentage of the US workforce from 26.4% in 1970 to 8% in 2018. Science has usurped manufacturing as the mother of production, and the working class is now largely based in services instead of physical commodity production, even in South America and sub-Saharan Africa. Whereas the capitalist class is a relatively dwindling minority of the world population, the working class, people dependent on wages for income, has grown exponentially. The IMF estimates that the effective global workforce quadrupled in size between 1980 and 2003, aided of course by the overthrow of the Soviet Union and the liberalization of the Chinese economy, adding 1.5 billion workers. But even the developed imperialist nations, those which are dependent on frequently exporting capital overseas, in order to expand and cheapen their exploitable labour base, have seen a deepening proletarianisation of the population. Proletarians have increased their already overwhelming predominance within the economically active population. Between 1980 and 2005, the proportion of waged and salary workers in the total economically active population in the developed nations steadily rose from 83% to 88%, which equated in 2005 to around 500 million people. In the US, the leading capitalist nation of our time, the figure is even higher, with waged workers as a proportion of the economically active population increasing from 90.6% in 1980 to 93.2% in 2011. And this graph shows the change in makeup of employment in America, with the green representing employment in agriculture, and you can see that's disappearing. The yellow in manufacturing, and again that's narrowing, and the red representing services employment, which is growing massively as a proportion of the workforce. It's around 80% in the US, in the UK and France and other developed nations. And I've written here that the green, yellow and red serve loosely as a proxy for feudal, capitalist and socialist bases of production. That rising red tide is another indicator of a socialist base of production arising. So let's get into the meat of this data, looking at the long-term indicators. So the average global rate of profit is trending historically towards zero, having fallen from an estimated 43% in the 1870s to 17% in the 2000s and 11% in the 2010s. And I've linked to the studies with those estimations, and these are some of the graphs. This one from Basu et al. Shows an estimate from 1960 to 2019, peaking at 15% around 1965, falling to just above 11% at the start of the 80s, rising again with the privatisation that came with so-called neoliberalism, then falling again. Of course, privatisation is a way of expanding commodity production, then falling again to below 11% around 2010, rising a little bit again and falling again before 2020. Another estimate, this time just based on the US rate of profit, shows it peaking at around 23% in 1966, but falling down to around 11% in 2020. Same trend found with the UK rate of profit. Interest rates, which are borrowing costs, have trended downwards over 7 centuries, or according to another study, 5,000 years, regardless of the political, banking, legal regime. And of course, interest is a form of profit parasitically siphoned from value originating in commodity production. I just emphasize this line about regardless of the political, banking, legal regime, because of course right-wing libertarians, for example, like to blame the invention of the central bank in 1913 for all of the economic crises that followed, but of course there were plenty of economic crises before that. The rate of profit and the rate of interest trended down historically well before the invention of central banks in 1913. And this long-term 7th century study is from the Bank of England, showing that trend. And then this study from the Bank of America shows a similar trend from 3000 BC. Gross domestic product growth rates in high-income countries are trending towards and already closing in on zero, having averaged around 6% in the 1960s and below 2% since the year 2000. We can see that on this graph here. The grey line represents the decade average, and it steps down, only rising slightly after 2010 for a few years because of deep austerity policies, which effectively redirected public funds into the private sector through subsidies and tax cuts. That chart is from the World Bank. The post-recession recovery from the 2007-09 global financial crisis, based on unsustainable debt and a temporary shale gas boom, which peaked in 2019, has been the weakest relatively since World War II, whereas US GDP grew by 43% over the first 39 quarters of the 1991 to 2001 expansion. In the first 39 quarters of the expansion up to March 2019, it grew by only 22%. At that rate, the latter would have had to continue for another 6 years to equal the aggregate growth of 1991 to 2001, and 9 more years to match the 54% recorded in 61 to 69. And that's outlined by this graph here from the Federal Reserve. Growth, the rate of growth is higher in 61 to 69, and then it's shallower in 82 to 90, slower again in 91 to 2001, and slower again in 2009 to 2018. In the UK, we've seen the trend line for GDP per head growth basically collapse. It's flatlined since the financial crisis, which means it's 30% below that previous trend line from 1955 to 2008. The rate of productivity growth has trended downwards over the past 7 decades to near zero. That's true in the UK, Germany, Japan, Italy, France, Switzerland, Canada, and the US. Germany and Japan were as high as 8% at the start of the 50s. All of these have fallen more or less, spluttering around 0 to 1% in the mid-2010s. The returns on US research and development fell during 1985 to 2015 by 65%, despite a 250% rise in the number of scientists and engineers engaged in R&D. And that's illustrated by this graph from Harvard Business Review. So moving on to some of the more striking data, almost half, 43% of around 9,000 commercial banks in the US disappeared between 2000 and the end of 2017, already down from 14,000 in 1986 and 30,000 in 1921. When I say disappeared, that's either through bankruptcies and or mergers. And we can see the same is true of savings institutions, which have more or less died out. As commodity production becomes increasingly unprofitable, surplus capital that can't be reinvested profitably in production is channeled instead into asset speculation and rentier capital. And that's illustrated here by the fact that so much is being invested in mortgages through the privatisation of housing. So the proportion of bank lending to businesses in 17 advanced nations has fallen relative to loans going to mortgages and property speculation, the latter from about 30% in the year 1900 to 60% in 2013. On average, non-mortgage lending accounted for 73% of the total in 1928, 65% in 1970, but only 40% by 2007. Similarly, the gap between value stocks and growth stocks, value stocks are basically financial dividends, growth stocks are basically returns on production, that gap has continually widened. A $1 investment in value stocks and a $1 investment in growth stocks in 1927 would have by 2020 diverged nearly 18 times in favour of value stocks to $51,500 against $3,000. But the earnings of the former depend on the success of the latter, since real value originates in commodity production. So as with banks, the number of US public companies through bankruptcies and mergers fell from 8,000 in 1996 to 4,500 in 2016 and 3,700 in 2022. Of 7 major merger and acquisition waves in the US since the 1890s, 4 have taken place since 1989. In the airline sector, for example, the top 4 firms served 43% of the market in 1985, rising to 72% in 2017. So this graph from the World Bank shows that the number of US publicly listed companies peaked in 1995 and has then fallen to around 4,000 by the mid-2010s. And this graph from imaainstitute.org shows these waves of mergers and acquisitions, basically the vast majority or the bulk of them happening since the 70s. So we've got a small first wave around 1900, a little bit of a longer wave around 1925, a third wave around 1960, and then it really takes off around 1985 and basically just keeps going. Obviously, it peaks here and here, but even here, we can see that there's still a lot of mergers and acquisitions happening all the time. The reason for this tendency towards ever greater mergers and acquisitions comes with the natural tendencies of capital accumulation. As productive output rises, the tendency for the devaluation of commodities accelerates. So to offset the ensuing falling rate of profit, Capital has to be centralised into fewer hands. Combining economies of scale generates greater efficiency in production, and joining forces with a competitor is also a savvy way of beating and defeating a third and fourth competitor. These mergers and acquisitions, like innovation, tend to happen most during periods of crisis when panic selling sets in and prices therefore fall, meaning the larger or richer companies or the ones with the higher profit margins can buy up the failing companies on the cheap. Although, of course, you do see expensive companies bought up at high prices because they're worth so much that you don't want competitors to buy them first. And even during the period of high interest rates, we have seen the continuation of mergers and acquisitions, albeit at a slower rate. And one of the reasons the likes of JD Vance has moved behind Trump, along with venture capitalists in general, is because the Democrats have been standing in the way to some extent of deregulation that would help speed up the acceleration of mergers and acquisitions. Just over 100 firms earned about half of the total profit made by US public firms in 1975, falling to just 30 by 2015. The top 100 firms in 2015 held 84% of all earnings, 78% of all cash reserves, and 66% of all assets. The top 200 companies by earnings held more than all listed firms combined. The aggregate earnings of the 3,500 or so other listed companies was negative. And according to Goldman Sachs, about 50% of listed US firms in 2022 were unprofitable, trending up from about 10% in 1960. Between 1964 and 2014, the average lifespan of S&P 500 companies shrank from around 60 to 18 years. And that is a very, very stark statistic. This graph from CB Insights shows that average lifespan falling from 60 in 1958 down to below 20 by 2010. And they see that trend continuing. This graph from Goldman Sachs shows the very negative, unprofitable companies rising to above 40%, with negative ones taking that up to about 50%, while there's another 10% of companies that still aren't that profitable. From 1977 to 2013, startups as a share of all US firms fell from 16.5% to 8%, a decline pervasive across states and sectors. That's illustrated by this graph from Census Bureau Business Dynamics. Fewer than 4% of US 30-year-olds in 2013 were entrepreneurs, compared with 5.4% of those born in 1965 to 80 and 6.7% in 44 to 62. The same downward trend in entrepreneurship has taken place among older citizens of prime working age. This graph from the Hamilton project shows that trend of startups falling in every industry. So it's not just a fluke or an anomaly or an aberration, it is a pervasive trend. Another graph from the Hamilton project shows the entrepreneurship rate by education level. People with an advanced degree becoming entrepreneurs has declined from 4% in 1992 to just above 2%. Those with bachelor's degree fallen from just above 3% to below 2%. Again, the same trend although not as sharply is seen with college and associate's degrees. This is a very interesting statistic. UK stock traders, although rising as a proportion of the population with each generation, are now holding on to shares for 0.8 years on average, down from 9.7 years in 1980, a decline of 91.75%. Similarly, US traders are holding on to stocks for 10 months, down from 5 years in 1975. That really explains, I think, in a material way, why the left has remained marginalised or relatively marginalised throughout the period of neoliberalism since around 1980, when lots of firms were privatised, workers were promised shares in companies, and many workers essentially became semi-proletarians, where they supplemented their wage with earnings from shares and dividends and that sort of thing. So here we can see in this graph from the Federal Reserve the percentage of US households owning stocks by percentile of income, and it's risen for every category. But in this graph from the WFE and the IMF, we can see that the time that they hold on to these stocks for is falling towards zero. So what we're going to see with the next crash, presumably, is the end of this trend of an increasing number of the population holding on, investing in stocks. I mean, it's a lot of it's penny stocks right now, and obviously technology's made that more accessible as well. But the returns are becoming so low that the amount of time people hold on to them is disappearing, and that's going to change the character of the class struggle, because it's going to tip the balance of forces. Whereas a lot of semi-proletarians at the moment think in capitalistic terms, they're going to become completely dependent on the wage and be fully proletarianized. And that's, as I say, that's going to tip the balance of class forces in the opposite direction and change the character of the class struggle itself. Of the roughly 750 currencies that have existed since 1700, only 20% remain. British pound sterling had by 2011 lost more than 99.5% of its purchasing power since its adoption as official currency in 1694. The US dollar in 2018 had lost more than 96% of its purchasing power since 1913, having barely changed in the previous 140 years, when relative growth was higher but absolute growth was much slower. The vast majority of that figure, 91%, ensued after 1949, when the US supplanted Britain as the world's dominant imperialist superpower, but the figure is 85% since 1970, or 93.5% for Britain, around the time of the first major post-World War II recession and the start of the digital computing automation revolution, which started the exponential rise in productivity. And we can see here this graph from the US Bureau of Labor Statistics. 2019's dollar was worth 4 cents of 1913's dollar, because devaluation and inflation are two sides of the same coin. Although the rate of innovation tends to slow down as the rate of profit falls, the pace of innovation tends to accelerate absolutely. Computing power tends to double every 18 to 24 months, and total production tends to double every 25 years. Devaluing commodities, as much less labour time is contained in each commodity, thereby also devaluing the money commodity. And that's important to stress, because, again, it's not just simply money printing. Money printing is a symptom. Production costs and consumer commodity prices have therefore trended secularly/historically towards zero, For example, whereas the world's fastest supercomputer in 1975 was worth $5 million or 32 million in 2013 money, the price of an iPhone 4 released in 2010 with the equivalent performance or power was $400. Aerospace companies producing propulsion systems in 2010 for $24 million in 24 months were by 2018 3D printing their engines for $2,000 in 2 weeks. You can find the reference for that at the bottom. 1 gigabyte of data storage fell from $193,000 in 1980 to just 3 cents in 2014, while sequencing the first human genome took 13 years and in 2001 cost $100 billion. The cost had fallen to below $1,000 by 2016 and takes about 24 hours. This graph shows long-term food prices. Obviously, there's been some big hikes at times, but the general trend, again, like most of these graphs, shows a trend line from a sort of top left position to a bottom right position. And the same again with the historical cost of computing, memory, and storage. In 2000, the cost of producing 1 kilogram of protein through what is called precision fermentation cost $1 million, but in 2020, the cost had fallen to around $100. As soon as a company like Nestle starts buying its milk this way, and it is already investigating the viability of doing that, as it must do to re-widen its own profit rates, the conventional farming industry will become uncompetitive and unprofitable. And we can see here again the trend lines for the falling costs of plant-based food, precision fermented food, and animal cell-based food, which is also known as cellular agriculture. And for more information on that, there's a link to a video by Rethink X. Moving on to the oil crisis, because we're running out of oil, it's becoming harder to extract and therefore more expensive and unprofitable. With deposits becoming shallower and deeper and extraction more capital intensive, i.e. dependent on machinery relative to labour, the energy return on investment on fossil fuel has fallen from above 101 in 1930 to around 3 or 6 to 1 in 2019, according to various studies that I've linked to. So the energy return on investment means that a return of 100 to 1 meant a return of 100 units of energy for every one invested. And again, this is important with regards to the labour theory of value, because the labour intensity, including the labour needed to produce capital intensive extraction machinery of fossil fuel production, and its non-renewability, thereby constantly reproducing the industry's demand for labour, has been pivotal to capitalism's overall profitability. So this graph from chrismartenson.com shows how that ratio has declined from 101 in 1930. It was about 25 to 1 in 1970, then 10 to 1 to 18 to 1 in 1990, and is now thought to be around 10 to 1, which means the energy available to society is not matching the energy required to get the energy that is needed to reproduce the present level of economic output. And oil, shale, and tar sands are even lower. We need to move to renewable forms of energy, which are forms of automation, which again will contribute to making capitalism obsolete. Another graph here, that one from To the Ends of the Earth, showing the same sort of thing, slightly different figures, but basically The returns needed to support the modern industrial society are not being met. Again, this one showing the same thing. The energy required to produce energy itself is rising, but we're not meeting that demand. This graph from Art Berman predicts that the tight oil or shale gas boom has already peaked in 2019, that it will rise again and peak again in 2027, but below that 29 peak, and then steeply decline continually amid a growing population. This chart from Wood Mackenzie shows how conventional oil discoveries are falling. Again, we've got a graph that generally starts in the top left corner and trends downwards to the bottom right corner. The tight/shale oil revolution breathed some life into the oil industry in the 2010s but peaked in 2019. In 2013 to 18, the world consumed 4 barrels of conventional oil for every 1 barrel of new discoveries. The value of Saudi Arabia's assets, mainly in oil of course, is predicted to fall from $900 billion to minus $2 trillion around 2030. In 2015, the total debt of the oil and gas sector globally stood at around $2.5 trillion, 250% higher than at the end of 2006. And the fossil fuel industry only remains profitable because of its ultra-parasitic dependence on debt and public subsidies. No bottomless pit, of course. Those subsidies add up to $16 billion a day, and it also relies on artificial cuts to production that normally raise consumer prices by 70 to 80% as it is. This graph from SR Sirocco report shows the average increase in oil production, and even in the 1930s during the Great Depression, oil production was rising by 3.6%, and since the 50s, growth in production has been below 2%, other than in the 2010s with that shale gas boom, that temporary shale gas boom that has already peaked. And here we can see the debt of Shell, Exxon, BP, Total and Chevron all rising. That's all of the long-term indicators, so let's move on to the short-term indicators. Trade restrictions have been hitting record levels since 2015, according to the IMF, which is, of course, before Brexit and the first term or the first presidency of Donald Trump. And this graph is from the IMF, and trade restrictions rising year on year, led far and away by the US, and that's since 2008 to 2019. Protectionism becoming the order of the day. And that is another sign that capitalism has served its historical purpose. It can't continue to globalize production. That means socialism needs to take over that job and complete what capitalism couldn't finish. The medium real revenue growth of FANG stocks from Facebook, Amazon, Apple, Netflix and Google, the best performing American technology companies of the 2010s, then comprising about 20% of the value of the S&P 500, turned negative in 2022 for the first time, as we can see from this graph from Bloomberg and Crescat Capital. 2022 was the worst year for stocks and bonds combined since 1871. Long-term US government bonds staged the biggest drop since 1788. The classic investor blend of bonds and equities put in the worst performance since 1932 during the Great Depression. Losses on the banking industry's investment securities totaled $690 billion in the third quarter of 2022, compared to less than $100 billion in 2008. At the height of the Great Financial Crisis, a total of 4,746 commercial banks in the third quarter held total assets of $23.6 trillion, matched by total liabilities, money owed, but devaluations of face value investments as a result of rising interest rates meant the banking industry as a whole was a conservatively estimated $400 billion short of solvency. And that's a conservatively estimated because it does not include exposure to hidden derivatives and cryptocurrency. So this graph is obviously very stark. These are the losses during the Great Financial Crisis, absolutely dwarfed, it matched roughly, probably exceeded actually in the run-up to 2019, but absolutely dwarfed in 2022. And yes, these are unrealised losses, but they will be realised at some point. On the subject of hidden derivatives, in November 2022, the Bank of International Settlements, which is known as the Bank of Central Banks, warned that mostly very short-term, geographically hidden off-balance sheet dollar debt held by financial firms had passed $80 trillion, which exceeds the stock of dollar treasury bills, repurchase agreements, and short-term corporate debt combined. In June 2022, the total market capitalization of crypto tokens plummeted from its peak in November 2021 by 70%. So you could probably expect the next crypto crash to exceed that. A third 1 in 100-year financial bubble in 3 decades. That is the first 3 to surpass the bubble that preceded the 1929 Wall Street crash, has engulfed the world economy and been labelled the everything bubble, since it now encompasses every asset or debt class for the first time, whereas the 2001 bubble was known as the dot-com bubble or the tech bubble, and the 2007-09 bubble was known as the housing bubble. But instead of only incorporating tech or only incorporating housing, this time it incorporates every debt class, including US Treasury bonds, which fundamentally underpin the global financial system. So this graph, based on data from the Fed and the IMF, show this bubble in 1928-29, where the value of the stock market around 80% of GDP, and then there was another bubble around 73, but it didn't exceed the one that led to the Wall Street crash. But then the dot-com bubble rose up towards 150% of GDP. The housing bubble was above 100%. And then the everything bubble is around 200%, so exceeding everything that's come before. And again, we've got 3 bubbles in quick succession in 3 decades, whereas before we had 2 bubbles in around 50 years. This graph, again, similar figures, slightly different, but that's from Blanco Research, which estimates that the market value, the average value of the stock market is 69% of GDP. It puts the figure in November 2021 at close to 230% of GDP. So the stock market is massively overvalued compared to the productivity of the US economy. The current AI bubble, which is part of that bubble, is bigger than the 1990s tech bubble, which led to the market crash of 2000-2001. And the present record high stock market growth of the last year or so has been driven by only 2 wildly overvalued stocks in Meta and Nvidia, whereas the rest of the so-called Magnificent Seven, Amazon, Apple, Netflix, Microsoft and Google, they've pretty much moved sideways, and as has the S&P 500 overall, which again expresses this increasing centralization of capital. Global debt in 2015 was 2.5 times higher than the global money supply, up from 2 times in 2013. According to the IMF, the private sector globally entered 2020 before the COVID-19 lockdowns with record debts. Official US national debt to GDP, driven by private sector debt that has been heaped onto the backs of the public, hit an all-time high of 128.4% in 2021, rising again to 131% in 2023, higher than the 119% at the end of World War II. In July 2019, US debt to GDP was estimated to be 2.5 times higher than the official figure once you include off-balance sheet debt like Social Security and Medicare, which are respectively estimated to be on course to go bankrupt in 2026 and 2034. So this graph from Trading Economics, based on data from the White House, shows that debt to GDP is at a record high as of 2021, higher than at the end of World War II. The US deficit is also tending to grow and is projected to continue to do so. Global debt to GDP, according to the IMF, has consistently risen from around 120% of GDP, world GDP in 1952, up to close to 280%, so it's more than doubled across 6 decades. To bail out private banks and private corporations by purchasing their debt, spending the money into existence, the balance sheet of the Federal Reserve, the US Central Bank, rose from $900 billion in September 2008 during the financial crisis to $9 trillion in 2020, an unprecedented tenfold increase, as illustrated by this chart from the Fed. And you can imagine it was a lot lower, or it was a lot lower before 2008 even. The US's M1 money supply, which is very liquid money such as cash and travelers' checks, rose from 1.6 trillion in May 2009 to 4 trillion in February 2020 to 16.5 trillion in June 2020 and 20.7 trillion in March 2022. The broader M2 supply, M1 plus less liquid monies, such as savings and money market funds, went from 8.4 trillion in June 2009 to 15.3 trillion in February 2020 and 22 trillion in April 2022. That meant 80.7% of all M1 ever put into circulation was printed electronically in just 23 months, 70% for M2 in 26 months. And for comparison, the total the US spent on its wars on Afghanistan, Iraq, Syria and Pakistan from 2001 to 2020 cost $6.4 trillion. So you can see from these graphs from the Fed the explosion in the money supply. So very interestingly, lifting the US economy out of recession has required, on average since 1958, a baseline interest rate cut in order to cheapen capital to incentivize lending, borrowing and investing. But since the worst ever stock market crash in March 2020, i.e. the fastest ever crash, rates were already near zero, having been cut after March 2020 from 0.75% in the UK and 1.75% in the US. Neither country had ever gone down to 0% before 2009. for this reason, we haven't really seen a proper recession since 2009, because there's just been so much debt piled up to basically stave off any recession. We had a short, sharp one in 2020, but that only lasted 2 months. And even the sort of official recessions we have had, where we've had 6 months or 2 quarters of negative growth, have been nipped in the bud through bailouts and massive public debt spending. I say that, just to reiterate that, I say that because we haven't seen a sort of 5 or 6% cut in the central bank rate. It went back down to zero, having risen to about 2.5% in 2018. It was pinned back down to zero, having languished there for 7 years after 2009. And obviously the rates have risen again now. They've done that because investment has fallen generally in the economy. That's pushed rates up, so the Feds had to raise interest rates for that reason, as well as trying to tackle inflation. The two reasons are totally intertwined, and they're going to have to cut rates at some point, because that will run out of steam. That policy will run out of steam. And to try and stave off or shorten the recession that's coming, they're going to cut rates back down to zero again. But the question is, will the recession be so bad, given that recessions are tending to worsen relatively each time, that they need to go into negative rates? And the question is, how deep into negative rates can they go before making capital unprofitable? The banking industry is certainly very opposed to negative interest rates. I suspect what we'll actually see is, after a fall in interest rates, will be a spike in interest rates higher than what we've seen in the last couple of years at some stage. How long that will take to materialise is obviously uncertain. So here's the central bank rate in the US since the 1950s, and it went all the way up to about 18% at the start of the 80s. But because debt is higher relative to wages these days, the interest rates today feel around the same as they were in the early 80s. And you can see that rates were kept at zero after 2009 and went back down to zero for a while again after 2020. Got a longer term view of the baseline interest rate in the UK from 1800, and we see here where it's below 1% after 2009 for the first time ever, and even lower in 2020, almost hitting zero absolutely. Obviously, there's this notion that the central bank sets the baseline interest rate, which is influential on the market, the interest rates on the market, but really and truly it's the other way around. The rates on the market determine what the Fed does in the end, or massively influence it anyway. And the Fed actually tends to lower the base rate following a decline in line with the yield on the 2-year Treasury, which falls with rising demand as investors without profitable opportunities in commodity production seek a relative safe haven. And that's illustrated by this chart from the Fed. So the yield on the 2-year rate is in blue, and you can see that the federal fund rate, the baseline central bank rate, follows that very closely. Again, this graph from Bank of America Research, Bloomberg, and Global Financial Data shows that credit tightens, and then credit and lending tightens first, and then the Fed cuts. So the Fed cuts to try and stave off a recession, but also when the recession starts, investment actually starts to increase because the price of capital falls, the price of investment falls, because with a start of recession, that's in response to a period where investment is too expensive, which triggers panic selling at cut rate prices. So investment starts, or at least tends to start, to rise again, and the Fed joins in with this and cuts rates, and then we see a recession. So that it's not the other way around. This myth that the Fed causes recessions by tinkering around with interest rates is just untenable. As smaller or poorer banks and corporations go bust or default on their debts to the central bank balance sheet, and thus the money supply, naturally falls, and so interest rates inversely rise, making new debt needed to pay off the interest on old debt more expensive, including for governments and central banks. In 2023, the Congressional Budget Office projected that the US government interest costs would grow nearly threefold from $331 billion in 2021, 2% of GDP, to $910 billion in 2031, from 7% to 12% of the federal budget, totaling $5.4 trillion over 10 years, making it the fastest growing component of the federal budget and 45% of the federal budget in 2050, $60 trillion or 9% of GDP. And that's far higher than the previous post-war peak of 19%. And that's illustrated by this graph from the Congressional Budget Office. Government debt servicing costs in 2023 had already doubled since 2021. After more than a year of rising interest rates at the start of 2023, the percentage change in the M2 money supply declined absolutely for the first time since the end of 1932 during the Great Depression, from a greater relative height and a greater relative steepness. From March 2021 to June 2023, the rate of M2 growth fell by 31% from its peak of 26.3%, contributing to disinflation, that's slowing inflation, of about 5%, compared to 12% and 10.5% actual deflation in 1932. The Fed itself started to operate at a loss in October 2022, with its long-term assets fixed at lower rates, but its short-term liabilities, that's money owed, burdened by rising interest rates, putting the Fed on course to have negative tangible equity again for the first time. That meant the Treasury stopped receiving the Fed's surpluses, a $100 billion plus annual revenue source, 4 times the annual budget of NASA. That's illustrated here in this graph from Bloomberg. Something I referred to a minute ago, it took 8 years of interest rate hikes peaking at 19% in 1981 to bring down the inflation of the 1970s. Lower wages relative to rising household debt levels mean interest rates of 3% in Britain in 2022 were the equivalent of 14% in 1980. That's illustrated by this graph from Built Place. Here we can see the total household debt tending to rise faster than households' gross disposable income. In 2019, after interest rates had crept back up from 0% over 30 months to 2.5%, the highest since early 2008, the US yield curve inverted for the first time since before the Great Financial Crisis. The inverted yield curve, that means the demand for the yield, that's interest, return or profit, on 10-year government bonds went lower than 2-year bonds, suggesting that the market as a whole is becoming more pessimistic about economic prospects for the near future. Remarkably, however, the inversion struck after the baseline interest rate had moved back down. The remarkable kept coming, while falling share and rising bond prices in a crisis usually generate falling interest rates. On the 9th of March 2020, the 10-year US Treasury bond interest rate spiked upwards, something that statistically should only happen every few millennia. I've just added some stuff about the inverted yield curve. So the difference between the 10-year and the 2-year treasuries, which is the gold standard when talking about the inverted yield curve, turned negative on the 6th of July 2022, and as of the 22nd of July 2024, this yield curve had been inverted for a record 747 days. And the longer yield curves are inverted for, the worse historically the recession that follows tends to be. So we can see from this chart from the Bank of America that the inverted yield curve, looking at the 2-year to 10-year treasuries, tends to uninvert before a recession or going into a recession. So it's a very strong predictor of a coming recession, and it looks like it's uninverting now after that record long inversion, as at the time of recording around the end of July. And the other thing of significance with regard to the yield curve is that as it started to uninvert last year, it did so in a unique way. The yield curve has always uninverted via short-term rates falling faster than long-term rates. For the first time, the yield curve started to flatten because long-term yields climbed faster than short-term rates, and that likely indicates that the attractiveness of US bonds as a safe haven during times of economic crises is seriously waning, at least relative to emerging alternatives such as the Chinese yuan. So we can see from these two charts, in the year to December 2023, the 30-year Treasury, which is at the longer end of the curve, rose from a bottom of 3.4% up to a height of 5.1%. That's in the upper picture here. While the 6-month T-bill at the short end of the curve rose from 4.57% up to 5.44%. In October 2022, the US's strategic petroleum reserve fell to a 38-year low of 21 days of domestic demand, down from 40 in 2020. The 283 million barrels sold in 2021-22 had taken 25 years to accumulate. The US's diesel reserve supply also fell to a historically low 25 days. In August 2023, the credit rating agency Fitch downgraded the US's credit rating, which investors use as a benchmark for judging how risky it is to lend money to a government, from AAA to AA+. As with any declining empire, the US military is using its equipment and weapons quicker than it can reproduce them, while drowning in debt and bleeding dry the tax base. And that's despite the fact that the US's military presence overseas, in terms of the number of active duty personnel, has been declining since the 70s. The US military spending has approached $1 trillion. So we see again the spending tending to rise as time goes on. This graph from Acquisition Talk shows how the costs of operating and supporting fighter jets has tended to rise exponentially. The costs of long-range standoff weapons similarly rising exponentially. The costs of bombers rising from, and this was just in the 80s, rising from 441 million per plane in 86 to 2.2 billion per plane, which meant that the fleet had to be reduced to 20 bombers from 132. Here's another graph showing the decreases in real GDP and export volume growth for the world, the US, China and Germany. Another graph from the Financial Times showing that financial flows, foreign direct investment and portfolio investment has peaked around the financial crisis and has been in decline since. So we finished going through all of the long-term and short-term indicators, and now we're going to talk about why this data indicates that we are heading for state monopoly socialism, as I call it, as an economic necessity for the first time. So the evolution of capitalism has turned it into what we call state monopoly capitalism today, a description of capital accumulation's ever greater dependence on A, state subsidies, i.e. public subsidies, and B, the increasing monopoly ownership of the means of production. And we've just got some more graphs to back all this up. The rise of private wealth and the decline of public wealth. Public funds are redirected into private corporations and businesses to offset their falling profit rates. Again, another example comes with the war on Ukraine. The United States is funding Ukraine in order to subsidize private companies based in the US. This graph from the MOD, UK Ministry of Defence, shows the percentage of 2021-2022's UK Ministry of Defence procurement budget spent on its top 10 suppliers. The think tank Commonwealth reported in July 2023 that BAE Systems pay just 14% of its own R&D costs and QNETQ only 4.5%. QNETQ's 23% return on investor capital was almost twice the FTSE average of 11.7% in 22-23, and the firm paid £43 million to shareholders, with the dividend per share being worth twice what it was a decade before. Commonwealth said BlackRock, Vanguard and State Street owned a combined average of 16% of the shares issued by the weapons sector. Here we see the 4-decade declining corporate tax rates in France, Germany, Ireland, Japan, UK, US and the OECD average. And again, this is evidence of public funds being redirected into private hands, because that money would have been funding public services and welfare, and it's been taken away and given to private corporations to prop up their falling profitability. Same again, total taxes paid by income group in the US, tax rates falling for the rich and rising for everyone else. A graph from the Hamilton Project showing the US market share by firm. So Google, Microsoft dominate search engines. Wireless carriers are dominated by Verizon, AT&T, T-Mobile, and it's the same in different sectors. Smartphones, Apple, Samsung, social media, Facebook, YouTube. A graph on the consolidation of US banks, and again on UK banks. This image shows some of the largest acquisitions by tech companies in the US. That's an image from visualcapitalist.com. And obviously, with the shift in power to ever more powerful monopolistic corporations, they have overseen a decline in anti-monopoly enforcement in the US since the late 70s. The trend towards monopolization of private corporations is also evident in China. Only 16 with unconditional approval in 2008, rising to 469 by 2020. Mergers between domestic companies in China significantly increased in 2018 to 20 and surpassed the number of mergers involving foreign entities for the first time. 98% of cases were approved unconditionally, with only 48 approved with modifications and 2 blocked during 2008 to 2020. The average time from case acceptance to review completion fell from 41 days during 2011 to 15 to 24.2 days in 2016 to 20. So the evolution of capitalism into state monopoly capitalism historically precedes the next evolutionary shift in the productive forces into state monopoly socialism. Private enterprise is to offset falling profit rates and improve productive efficiency, increasingly dependent on state public subsidies, trending towards 100% of income and therefore so-called nationalisation or public ownership. 2, mergers. And 3, real-term and long-term central planning in the form of eliminated internal departmental competition, centralised databases, and real-time stock analysis, plus long-term budgeting and forecasting and so on. Taking the means of production under public ownership, a final merger, and centrally planning the economy as a whole is therefore becoming for the first time an economic necessity. The total monopoly resulting from the final merger cannot be privately owned, since there is no exchange of ownership of commodities within a total monopoly. The public owns the means of production, and the utilities produced are therefore decommodified, making trade, coordinated distribution between social enterprises, actually free. So we've seen, just to reiterate, we've seen that the number of banks and publicly listed companies are in decline in number through bankruptcies and mergers, so we're therefore heading towards a final merger. Since the private sector is losing its ability to employ value-creating, that is, commodity-producing labour, it does so only if profitable. Society must take over responsibility for employment via governmental departments and social enterprises, enabling actual full formal employment. So-called full employment in capitalism discounts the lumpenised and destitute or economically inactive workers. Here we can see that with every recession, the rise in unemployment tends to worsen. Since the workforce is now almost entirely services-based, economic stability can only be established with a compatible system whereby value is created not by for-profit commodity production, but by break-even utility production. Since fiat currency is dying a natural death, with cash also disappearing in relative terms, it must be replaced by non-transferable digital vouchers, with the currency in inverted commas pegged to labour time. Workers will therefore receive all the value they create during the working day instead of having part of it appropriated by capitalists, both at the point of production during working time and in the form of public subsidies, paid in units of labour time worked, minus contributions to universal public services and state/governmental expenses. A grading system will incentivise types of work such as night shifts and productivity rates. Consumption prices will tend to fall to zero, rising only with falling demand of no longer popular or obsolete products, for example. Combined with public ownership and full employment, this system institutionalises the equality of labour, underpinning equal rights, whereas rights under capitalism only really exist to the degree that you have money, limits economic inequality, although the most productive workers will still earn the most, and consistently raises living standards for all, especially via general falling prices. Digital vouchers are non-transferable, cancelled like train tickets once spent, and so the centralisation of wealth into fewer hands becomes impossible. An all-socialist state, made up of socialist parties, will oversee a transitionary period in which competing private production is increasingly taken under singular public ownership via negotiated long-term debt payments to the last capitalists in order to minimise conflict. Once that transition has been completed, i.e. globally, the state will have withered away, since the state is by definition the absolute authority of one class over another. In the long run, as artificial intelligence, 3D printing, lab-grown food and so on become increasingly accessible, localised and personalised, the divide between producer and consumer will increasingly disappear, bringing about increasing economic independence and abundant material wealth for all. With previously exploited and underdeveloped peripheral regions becoming increasingly prosperous, the centrality of remaining ex-state governmental organs will tend to wither away or decentralise into regional, localised self-governance. So whereas capitalism has a long-term tendency to centralise wealth and power, socialism has a long-term tendency to decentralise wealth and power. Essentially and historically, socialism completes what capitalism started but could not finish. Just as a side note, digital data, precision fermentation, 3D printing, bioplastics, microbial fuel cells, nuclear fusion, and so on are forms of additive manufacturing, growing, replicating, layering, and fusing, as opposed to subtractive manufacturing, where metal or trees are subtracted and shaped from mines or land, for example. So polluting, non-reciprocal, subtractive and mechanized production equals limited, scarce production equals capitalism, whereas clean, reciprocal, additive and automated production equals unlimited/abundant production equals communism. And obviously there's going to have to be a transition from one to the other, but that just touches on the fact that capitalism is also responsible for the climate crisis. You can't understand the climate crisis and its causes without understanding the labour theory of value, because as touched upon, the labour intensity of extractive production is profitable, and capitalism needs to increase the labour intensity of production. That's the end of the article. I'll just stress that I think it's very important to get this information exposed to as many people as possible so that they understand what's happening. Obviously, most people are blaming all of the deteriorating conditions on greed and human nature, or whatever argument it is along those lines. But there is a fundamental, historically objective tendency underlying everything that is happening. And the more people we can get to understand that, the better state the movement will be in as the emerging struggles intensify.